Welcome to this explainer. Today, we're cutting through the noise to objectively examine the mathematical reality behind systematic investment plans, or SIPs. We're stepping completely away from the social media hype and taking a serious, no-bluff look at the actual mechanics of long-term wealth creation. No overnight riches here, just the cold, hard numbers.
So, will 1 crore tomorrow actually feel like 1 crore today? It's the ultimate question, isn't it? You log online and your feed is just flooded with screenshots of massive multi-crore portfolios, usually with some generic advice telling you to just start an SIP. People see these projections of a crore after 15 or 20 years, and they instantly imagine total freedom, luxury, and absolute security. But before we trust any online calculator, we have to ask, will that future wealth actually hold the exact same purchasing power it has right now? Because there's this massive gap between expectation and reality in retail investing. On one hand, you've got the social media illusion, quick luxury and effortless freedom, heavily marketed to a generation that's frankly looking for an easy out. But on the other side, that's the mathematical reality. We're talking about eroding purchasing power and decades of boring, relentless discipline. Real wealth creation just isn't an overnight success story. It requires a fundamental understanding of how money actually behaves over long, uninterrupted periods of time.
Okay, let's strip the systematic investment plan down to its absolute core. Mechanically, it's just a disciplined method of automating your investments with a fixed amount at regular intervals. By doing this, you're forcing something called rupee cost averaging into your portfolio. Instead of manually trying to time the market, which, by the way, even seasoned professionals fail at, you're automatically buying more units when the market panics and prices drop, and fewer when prices peak. It completely removes that paralyzing guesswork from the equation. Now, the financial industry loves to focus entirely on the math, but they often underestimate the behavioral advantages of this automation. Think about it. When cash just sits idle in a savings account, it's incredibly vulnerable to our worst psychological biases like impulsive spending and lifestyle inflation. By creating a forced investing habit, an SIP actually enforces delayed gratification. It quietly but powerfully rewires your financial behavior over the years, shifting your mindset away from short-term consumption and firmly toward long-term financial thinking. And once that behavioral discipline is locked in, well, that's when the math takes over through the compounding effect. It's a simple concept, but human brains historically really struggle to intuitively grasp it. Basically, your money generates returns, and then those returns start generating their own returns. As humans, we're wired to think linearly, but wealth grows exponentially. The most critical variable here isn't the initial size of your capital. It's the amount of time you let that capital sit there undisturbed. Let's track how this plays out for an ordinary investor committing a modest 5,000 rupees every single month, assuming a hypothetical 12% annualized return. After 5 years, the total you've invested is 3 lakh rupees, which grows to a value of around 4 lakh. It's a solid, modest start, but stretch that timeline out. At 10 years, the 6 lakh you invested jumps to 11.5 lakh. And by year 15, your total contributions have reached 9 lakh, but the value is sitting at approximately 25 lakh. This is exactly where that exponential curve finally accelerates. Let's look a little closer at what's happening under the hood at that 15-year mark, because there is a stark contrast between your manual effort and the market's effort. You contributed out-of-pocket capital totaling 9 lakh rupees, but the wealth gained purely from compounding returns? That's 16 lakh. The invisible engine of compounding has drastically outpaced your manual labor to reach that final value of 25 lakh. Your money is literally working harder than you are.
Now, it looks absolutely magical on a calculator, but this is where we have to pivot sharply back to reality. Because while compounding works to grow your numbers, there is a silent wealth killer operating in the shadows, and it's called inflation. We so often think of wealth purely as the balance in a bank account, but rising costs, groceries, healthcare, real estate, they are constantly, silently siphoning away the real-world value of those growing numbers. The math is relentless.
To mathematically understand inflation's destructive power, financial professionals use something called the Rule of 72. Traditionally, it's a formula used to estimate how long it takes an investment to double. But if you flip the perspective, it's also the exact formula used to calculate how many years it takes for inflation to cut your purchasing power entirely in half. You simply divide the number 72 by the current annual inflation rate. So let's run the math on a conservative average inflation rate of 6%. 72 divided by 6 gives us a critical number, 12. What does this mean? It means that mathematically, every 12 years, the purchasing power of your money is slashed by exactly 50%. A lifestyle that costs 1 crore rupees today will require roughly 2 crore rupees in just 12 years, simply to tread water and maintain the exact same standard of living.
Now, let's deconstruct that 25 lakh figure from our earlier compounding projection. It feels like a massive victory when you see it on a glowing screen, right? But when you apply the harsh reality that purchasing power halves roughly every 12 years, that future 25 lakhs simply won't buy the same freedom it represents today. The nominal numbers grow, absolutely. But the financial oxygen those numbers provide, that shrinks. And this is the exact truth that simple online calculators hide from you.
Which brings us to the harsh limitations of mutual fund SIPs. An SIP is a highly effective tool, for sure, but it is not a flawless, guaranteed, or magical path to riches. Treating it as a set-it-and-forget-it ticket to guaranteed wealth completely ignores the actual, often brutal mechanics of the financial markets. We need to look at this objectively, strip away the marketing jargon, and face the risks head-on.
The reality is, the market is fundamentally ruthless. As an investor, you have to navigate severe volatility and endure prolonged periods, sometimes stretching into multiple years, of negative or entirely flat returns. There are absolutely no guaranteed minimums in equity. And more importantly, surviving these cycles requires extreme emotional stability. When a systemic crash wipes 30% off your portfolio's value in a single month, continuing to make that monthly investment takes a massive psychological toll. And this is exactly what catches beginners off guard. On an online calculator, SIP theory is a straight, uninterrupted line launching smoothly up into wealth. But reality? Reality is a jagged, chaotic ride of volatile cycles, agonizingly slow growth phases, and profound daily boredom. Sticking to the plan through these phases is a test of your psychological endurance far more than it is a test of your financial literacy.
Because of this, relying solely on passive mutual fund returns to make you rich is mathematically flawed if you ignore the active side of your financial life. An SIP is merely a vehicle. Your active income, that's the fuel. You cannot cost average your way to massive wealth if your earning capacity stagnates and inflation eats away at your investment margins. The real work happens outside the portfolio.
A truly realistic, holistic wealth strategy treats equity HIPs as just one piece of a much larger puzzle. True resilience requires continuous skill and income growth, robust emergency funds to prevent you from panic selling during inevitable market crashes, and comprehensive health insurance to protect your capital from sudden medical bankruptcy. Miss just one of these elements, and your entire strategy can fracture under pressure.
So here is a grounded roadmap for realistic wealth building, and it operates in a strict, unyielding sequence. Step 1, build a 6-month emergency fund in highly accessible accounts. Step 2, secure your defensive lines with comprehensive health and term insurance. Only when that fortress is built do we move to Step 3, starting those SIPs early and running them consistently. And surrounding all of this is Step 4, continuously increasing your primary income through active skill development. It all comes down to this core truth. The real power of an SIP is not becoming rich overnight. The real power is slowly becoming financially stronger, year after year. That perfectly encapsulates the no-bluff reality of investing. It's not about short-term excitement, beating the index every quarter, or perfectly timing market dips. It is about building an incremental, unyielding financial armor.
I'll leave you with this provocative thought as we wrap up this explainer. Are you building true financial freedom with a holistic, inflation-aware strategy? Or are you just chasing nominal numbers on a screen? True wealth is built quietly, deliberately, and with a full understanding of the mathematical realities of the world. Take a hard look at your strategy today.